Hello guys, we have seen two illustrations in the previous video. In illustration 1 we have seen how to calculate the net cash inflow after tax, and in illustration 2 we have seen how to do relevant cost analysis for decision making. And before starting illustration 3, in the previous videos we have listed various type of cash flow techniques used for project evaluation. What are those? Non-discounted techniques and discounted techniques, discounted cash flow techniques. Under non-discounted techniques, what are the method we have seen? ARR method and payback period method. In payback period method we have seen three types: traditional payback period method, payback profitability method, payback reciprocal method. Now let's come to the illustration 3. A project costing 10 lakh having a life of 5 years is expected to generate profit before tax and depreciation of 2 lakh 50,000, 3 lakh, 3 lakh 50,000, 4 lakh and 5 lakh respectively. Assume 33.99% tax and 30% depreciation on written down method. Compute ARR. So now we are going to see one of the method in the non-cash flow technique, that is ARR, average rate of return method. So what is the formula for ARR method? Average annual profit after tax divided by average investment into 100. So let's see the first part of the formula, that is average annual profit after tax. In this table, we have seen how they are calculating the average profit after tax. Question, they have given profit before tax and depreciation. So first line they have listed the question, they have listed the profit given in the question and depreciation. So before calculating the tax, what we are going to do, the one important thing is we have to deduct the depreciation for each year. So what is the depreciation method they have given? Written down value method. So we have to calculate 30% on written down value for each year. So written down value will be different for all the 5 years. That is, we have to calculate 30% on 10 lakh, that is the cost of the project, that is 3 lakh, and subtract the 3 lakh from the 10 lakh. We will get 7 lakh as the written down value for second year, and then we have to calculate 30% on written down value 7 lakh, then we will get 2 lakh 10,000. Similarly we have to calculate for all the year. Then they have subtracted the depreciation from the profit before tax. We get profit before depreciation and tax, we get profit before tax. Here one thing we have to notice, in the first year the project occurs loss. So how we should treat this loss for tax purpose? In the first year we no need to calculate any tax because it is a loss. But for the second year, what we have to do is 90,000, it is a profit. We have to deduct any losses from the previous year. From this second year profit, we will get 40,000 profit amount. In that we have to calculate the tax amount. So that is 33.99% on the 40%, not on the 90% profit. And the third year, fourth year and fifth year, it is a normal calculation, 33.99% on the profit before tax amount. Only changes in the first year and second year. And after deducting these tax amount, we will get profit after tax. This is the profit after tax. We have to find average for all the 5 years. add the 5-year profit and divided by 5. So second part in the formula is average investment. For this, first year they have given beginning 10 lakh and deduct the depreciation. So beginning investment amount is the initial amount 10 lakh and investment at the end is the investment amount after depreciation. So this 7 lakh is the beginning investment amount for second year. Similarly, we have to deduct the depreciation amount. The end amount is the after tax end amount is the after depreciation amount 4,90,000. So average is the beginning and ending divided by 2, that is this 8 lakh, that is the average amount for all. That how to calculate these average? Beginning amount plus ending amount divided by 2. Then use the formula. Average annual profit after tax is a 1,27,805 and average investment is a 2,04,085 into 100, that is 27.11%.